once we have a good understanding of the Federal Reserve System, now we can talk about how the quantity of money is controlled by the Fed. Okay. Now let's start our discussion with the monetary policy tools. There are multiple tools the Federal Reserve can use to control the money circulating in our economy. And the primary tool is called the open market operations. That means the Fed can buy or sell the bonds or bills issued by the Treasury Department. Okay? Now we know, the U.S. government is running a huge budget deficit year by year. So the government needs to issue the bonds on the market to finance its budget. Okay? And these are called the treasury bills or treasury bonds. Okay? Depends upon the maturity date. And so the Federal Reserve can buy the bonds or bills on the market or sell what they already buy or already bought. And it's called open market operations because the market is open to almost everyone if you're interested. Okay, you and me as an individual or households, we can buy and sell treasury bonds. Okay, and we also find a lot of financial institutions, commercial banks are also buy and sell the T-bond or T-bills on the market. Okay, and how much treasury bonds they're supposed to buy or sell, at what point, like timing, okay, they're supposed to buy or sell. All of these decisions are going to be made by FOMC, Federal Open Market Committee, okay, which we again briefly mentioned in the previous video. Okay, we said that there are supposed to be 12 members sitting on this committee. Okay, that includes 7 members of the board plus 5 of the 12 regional banks presidents. Okay. Now here is a picture of one of the FOMC meetings several years back. Okay. And you would find that here sitting in the middle, that's Ben Bernanke, who chaired the Federal Reserve then. Okay. And you can also find here Janet Yellen. She is the former chairman of the Federal Reserve. Okay. And you also find again the other board members and the presidents of the regional banks sitting in this room. Okay. And during our meeting, I will click on this web link so we can check out who are the current members, okay, and some other details about the FOMC. All right. And now, how could the Fed raise the money supply through the open market operations? If the Fed wants to raise the money supply, it wants more money circulating in this economy. What it needs to do is to print the new money and use that to purchase the bonds or bills issued by Treasury Department. That's it. Okay, so through that, the Fed pumps the new money into the economy, and it holds the Treasury bonds or bills as its own asset. Okay. Now, vice versa, if the Fed wants to reduce the money supply, it should sell the assets. Sell the Treasury bonds or bills it purchased before. Okay, so by selling these bonds, for example, you and me as a household investors or commercial banks, if they purchase the bonds, then they have to, use their own money to make the payment, right, to the Federal Reserve. And so through that process, the Fed is actually sucking the money out of the economy, all right? So it will reduce the money supply, all right? So this is the primary tool of monetary policy. But of course, the Fed has, many other options in its toolkit, okay? So open market operation is the primary one. Another one, which is also used quite often, is called reserve requirement. Okay, and the reserve requirement means, these commercial banks operating in the United States, they are supposed to reserve a fraction of the deposits they received, just in case people would come back and withdraw the money. All right. So, for example, let's see, for Bank of America, suppose the reserve requirement set by the Federal Reserve is 3%. That means for every $100 the Bank of America receives from households, from private businesses as deposit, it has to keep $3. So that's $100 times 3%. $3 got to be kept in the office of Bank of America. Okay? Again, so that if some of us, of course they don't expect all of us to go back and withdraw money right before the the deadline, before if we purchase a certificate of deposit for 6 months, so before 6 months, and so they just need to keep a small portion of the deposit in their office. Okay. Now, how could the Fed raise the money supply by changing the reserve requirements? This is pretty simple. Okay. If the Fed lowers the reserve requirement, let's say from 3% to 1%, okay, then for every $100 the Bank of America receives as a deposit, there will be $2 more available for BOA to lend out, right? Because it used to, reserve $3 to meet that 3% requirement. Now they only need to reserve or keep $1 in their office, because the reserve requirement has been lowered to 1%, right? So there will be $2 more available to be lent out, and so the money supply should go up. Okay, there are more money that can be pumped into the economy, and for sure the banks are going to be more aggressive in terms of lending out the money. Okay, so vice versa, if they want to lower the money supply, they're going to raise the reserve requirement, so these commercial banks have to keep more money in their offices. Okay, and these money cannot be used in other economic activities, right? Now, you probably want to know, what's going to happen if a commercial bank fails to meet that requirement. For example, let's say if the Bank of America, based upon its deposit received, is supposed to, keep $3 million in its in one of its local offices, right? And suppose at 4:59 in the afternoon, so 1 minute before the end of the business day, a businessman walks into that local office and said that he desperately need to borrow $1 million from Bank of America, and he made a pretty appealing offer. Okay? He is willing to pay a higher than average interest rate. All right. So Bank of America, as a profit maximizer, there's no way then there's no reason for them to turn down the offer, right? So what BOA will do is to go ahead and lend the $1 million to that businessman. But the next issue BOA has to deal with is how could they meet the reserve requirement by the end of the day? Because the Federal Reserve will check that every day at 5 p.m. to make sure every commercial bank meet the requirement. Okay, in these days when everything goes online, becomes computerized, it's pretty easy to do that. Okay, in their computer systems, they can check, who meets the requirement and who doesn't. All right, and so here, what we find is, Bank of America is running $1 million short to meet the requirement, and there are several options they could do. One option is go to this market called federal funds market, where you can find other commercial banks, okay? And some of them would, just like Bank of America, they're running short of a reserve requirement, so they go over there and trying to borrow money from other commercial banks. They happen to have excess reserve, so they reserve more than what they are required to do, right? Now, if they reserve more, they are willing to lend out their money, their excess reserves, right? So Bank of America could borrow $1 million over there to meet the reserve requirement, all right? Remember, they have to get that done by 5 p.m. every day, all right? Now, money is not free for sure, right? So whatever amount, like we said in this case, $1 million borrowed by Bank of America, it has to pay, the interest rate, okay, to the lender or the lending commercial banks. And so that's called the federal funds rate, okay? Federal funds rate is another very important indicator for monetary policymakers to monitor what's going on this federal funds market. Okay? Because how high or how low the federal funds rate will determine eventually the rates for car loans, mortgages, and other things. Okay? So it's kind of the benchmark rate, right? So this is a second monetary policy tool, reserve requirement. Now, Bank of America, if it's running $1 million short for the reserve requirement, there's another option for them to meet their requirement. Instead of going to the federal funds rate and borrow from other commercial banks, they can go to the Federal Reserve, okay, the central bank, and borrow directly from the central bank to meet the requirement. Okay, and when they borrow from the Federal Reserve, they also need to pay interest rate. It's called discount rate or discount window. Okay, so this is the interest rate that the Federal Reserve charges on the borrowed reserves. Okay, why it's called discount rate? Because this rate is more like the wholesale price on the market. So it's lower than, as we said before, the car loan rate or the mortgage rates. Okay, sometimes much lower than that. So because this is not, not supposed to be provided to the households or private businesses. It's provided to the commercial banks, right? So if the Federal Reserve wants to raise the money supply, they're going to lower the discount rate, okay? So, once they lower the rate, Bank of America find that, well, it's pretty cheap to, borrow directly from the Fed. So if they have, the like that businessman we talk about, right, or any other customers who lead the money, they're pretty happy to, the BOA is pretty happy to lend the money out. Okay, even they're gonna go below the reserve requirement, they won't worry about that. They just go to the Federal Reserve and borrow directly from them. Okay. And vice versa, if they want to lower the money supply, they're going to increase their discount rate. So it's more expensive to these commercial banks to borrow. Okay? And of course, they have other instruments. Okay? And the performance